All right, I want to get this update to you. Inflation ticked up for a second straight month in August. That's according to the Bureau of Labor Statistics. Consumer prices climbed 3.7% last month from the year prior. It also rose 0.6% on a monthly basis. That's the biggest month-to-month increase this year. Now, climbing energy costs largely contributed to the rise in overall inflation. We're specifically speaking about gas prices as well. As you see on your screen, those rose more than 10% in August from the month before. In his response to the latest CPI report, President Biden said he knows this increase, quote, put a strain on family budgets. He also acknowledged that core inflation is trending downward. So what does that all mean? Jeanna Smialek joins us now. She covers the Federal Reserve and the U.S. economy for the New York Times. Jeanna, let's speak about core inflation, which excludes food and energy costs. The president is correct in saying it's trending down, but costs still jump, on an annual and monthly basis in August. For folks at home, they're still feeling the pain of inflation. So what should we make of all these numbers?
Yeah, so I think it is clearly the case that the headline numbers, which are really the ones that capture how Americans are feeling about inflation, what people's budgets are going toward, those are looking pretty steamy still and picked back up, as you noted. And so I think for your typical household, that doesn't feel great. It is true what the president says here that core inflation on an annual basis cooled down in August. Unfortunately, on a monthly basis, it actually ticked back up a little bit. That 0.3% number is up from 0.2% in the last 2 months, and the first monthly acceleration we've seen in this gauge in 6 months. So that's something to worry about a little bit, something to keep an eye on, because you don't want to see that number heading up on a monthly basis. It's really one of our best gauges of sort of the momentum that's underlying inflation. And so I think that's something that policymakers at the Federal Reserve, economists on Wall Street are likely to be keeping an eye on over the next couple of months.
And the question we get, I'm sure you get it all the time, is always, well, does this mean inflation or at least interest rates will continue to tick up? We know the Fed focuses more on core inflation than overall CPI. So this is my opportunity to ask you that question. Do you feel that because of all this, interest rates may jump again when the Fed meets this month, or might we be easing?
Yes. So I think this is not enough in itself to cause the Fed to raise interest rates. It definitely seems like investors are preparing for a world in which the Fed hits pause at their upcoming meeting on September 20th. But I do think it's probably enough to keep the Fed thinking about whether they need to raise interest rates again before the end of the year. I think we're likely to see a situation where Fed officials aren't ready to sort of stick a fork in it and say we're done and declare an end to the hiking cycle at a time when they're a little bit, there are some signs that inflation could be a little bit stickier than we had previously expected. So, this certainly, when you talk to economists, they'll tell you this probably means that we're still quite a ways away from talking about actually lowering those interest rates and bringing down borrowing costs for consumers.
And the place where most of us see the impact of these rising interest rates are in mortgages. I know that applications fell to their lowest level since 1996 as rates continue to jump. And I saw another report finding that many people were upside down on their homes if they bought a home recently. So what is your view of the current housing market, and is there reason for concern yet?
So, in a way, that mortgage applications falling is exactly what the Fed is going for here. A big way that we slow down the economy to try and wrestle inflation back under control is by slowing down the housing market, and that has knock-on effects throughout the economy. It's actually really been a surprise so far how resilient the housing market has been to the very substantial increase in interest rates we've seen over the last year. But we, as you allude to, we're seeing some signs that that's beginning to crack. So I think not necessarily something to be worried about. In fact, potentially something that's happening by design, but obviously something that could be painful for some homeowners who have recently purchased.
Yeah, sometimes we forget cooling down the economy is the point. Jeanna Smialek, great to chat with you. Thanks for being with us today.
Thank you.